Well, markets are rallying today despite concerns about that potential AI bubble. However, our next guest says investors have been rotating out of crowded sectors and into less followed areas and has a few investment ideas to share. Joining us now, David Burrows, Chairman, Chief Investment Officer with Barometer Capital Management. Good morning. Welcome.
Good morning. Thanks for having me.
Let's get into this too, shall we, David? Too, you said that market leadership is narrowing, at least in your view too. What does that signal to you about the current level of market risk as a result?
Sure, it's a great question. So we all have this tendency to follow what the index is doing, and that's important. But we know underneath the surface there's good and there's bad. And in general, in a healthy market, over time, more and more companies should participate in a rally. Over the last 3 months, we started to see some narrowing take place, meaning fewer and fewer stocks doing well. But it is interesting because there are some sectors that actually are important for the Canadian market that are less important in the US market that are performing better. And some of the more crowded areas of the market, are having a tougher time. And so it's an interesting time for investors, especially individual investors who can target where they're focusing. And we have been focused more in Canada. We've been focused more internationally. And focused on assets that do a little better in a more inflationary environment. There are some risks that the Fed, is maybe cutting a little too early if they cut again in December.
Yeah, okay, so a little bit to break down there for us, if you can. Let's talk about the Canadian market too, in particular, where you've been focusing, where you may be seeing some of the most rotation when it comes to some of the investor positioning right now.
Well, it's interesting. There is consensus, for instance, that oil prices have to come down in 2026, that we have too much supply. And certainly oil prices have been weak, here in the high 50s. But when you take a look at the XEG, which is the ETF for the major Canadian oil and gas producers, or some of the big leaders, they've been performing remarkably well. Now, in the S&P, energy is like 2% of the index. And it's not always been that way. Early 80s, it was over 20%, but many years of underperformance. But for the Canadian market, obviously, energy is a lot more important. So companies like Imperial Oil or Tamarack Valley, just marching ahead, despite the fact you see weak energy prices, and that's definitely an out of consensus view.
Yeah, certainly interesting too as we get into it. Now, you touched on the Fed, and let me just let me talk about that before I get into some of the rest of this too. Indications, at least from the New York Federal Reserve and the head of that on Friday, that a rate cut again in December isn't off the table. What's your reaction to that and the impact it could have?
Yeah, it's interesting. I mean, certainly inflation has been coming in ahead of target. I think in the most recent measure, 72% of the components in CPI were above the Fed's target of 2%. So there is risk of a resurgence in inflation. That has been the case historically. You get a first surge of moderation over several months, and then you get a second surge. And I think that the market would tell you there's a risk of that. When you look at more inflationary sectors like financials, and energy and materials and industrials all do better in a more inflationary world, and they've been the leadership. On the other hand, things like the more defensive sectors that tend to act more like bonds have been in general over months underperforming. So I think that there is a real risk there, and I think the market is perceiving that. I mean, look at how strong gold has been.
Mm-hmm. Yeah, and clearly investors finding some at least or they're looking for some certainty in a very uncertain market right now. You just touched on bonds too. Some of those high yields, long-term bond yields, at least for now. How is that contributing to, at least right now, and impacting equity markets, in particular some of those big growth stocks that we have seen?
Yeah, so I think it's kind of a big deal. Last year when the Fed cut rates in September, for the first time in 40 years, long-term rates went higher, not lower. That's bond investors discounting the risk that maybe inflation stays higher for longer and they want to get compensated well. Well, when you pay a very high multiple for a growth stock, you got to take all those future cash flows and discount them back to the present using some discount rate, which is generally based off a long-term interest rate. So it's tough for higher multiple growth stocks when long-term yields stay higher. And that has been an issue over the last 5 months. Value in general has been outperforming growth, and we'll see whether that continues. But certainly, many of the areas that would be considered value today or less owned sectors are sectors that are a little bit more inflation leaning. And so investors just have to take that into account. And I think realistically, in our view, inflation is the bigger risk to investors than disinflation or falling prices.
Yeah, which is interesting. So on that too, so take me through the portfolio too, where you stand right now, at least for you, cash versus equities, at least for now.
Yeah, so we have a little bit higher cash than we would tend to, and that's just because breadth has been there, and we've over the course of the year come out of sort of 2/3 of our tech exposure. Thankfully, Google continues to be one, but we just see other opportunities. We've been focused on companies that generate a lot of cash. Companies that generate cash and return it to their shareholders by way of dividends and share buybacks. Doesn't really matter what financing costs do if a company generates tons of excess cash. And the second thing that we've been focused on is dividend growth, because when people are facing a rising cost of living, having a rising stream of dividends helps offset that. And that certainly was the case in the 60s and 70s in the last sort of inflationary build-up period. And then the third one is companies that have very, very long backlogs. That mean even if you got an economic slowdown, they've got a really good buildup of future business and predictability over the next few years. And so we're trying to focus on companies with those sort of three key themes.
Okay. David Burrows, Chairman and Chief Investment Officer of Barometer Capital Management. Thanks so much for this, David. Appreciate your time.
Thanks for having me.